Hello and welcome to episode 252 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, Happy New Year, how you doing?
Happy New Year to you and Happy New Decade, Andy. So, no, it's good to be back. We've had a nice break over the Christmas period. It's quite nice to spend time with the family and everything and to not think about money. I think it's always important that people don't always obsess about money stuff and have a break from it. So I did try and have a break from reading too much money news and stuff like that.
It's difficult for us though to not think about money when we've both got Christmas and a daughter's birthday to think about.
Yeah,
because that depresses me
all at once. So we're back and we're back in earnest next week. So this is going to be probably a shorter than normal podcast because we wanted to say hello to everybody, Happy New Year, and do a few bits and pieces about the new year, new money and everything like that in terms of new you. That's the big theme. And we're going to do midweek markets as of next Wednesday.
Yeah.
So that will be on and around the 8th, and then the podcast will be back in full next week. The big thing though, like I mentioned there, is the new year, new money and everything, like new me. And it's actually the biggest resolution, isn't it, out there? The biggest New Year's resolution is related to money.
Yeah.
And I thought it was important to do a podcast based around that because people are very enthusiastic about reading money content and trying to do something. And if you want any sign of that, then it was interestingly yesterday, which is the 2nd, it was the 2nd of January, was our biggest ever day for traffic on the website. The most pages ever read. And now think about it, we've been going almost 10 years, Money to the Masses, and after a decade, our biggest ever day is still, that just shows you how much what we're doing is growing and how it's so important that you guys keep sharing and doing everything to help promote what we do. But on the wave of that, and also the enthusiasm for people to try and sort their money out, it was our biggest ever day, which was quite incredible.
No, that's it. It's super encouraging. And I had a bit more of an extended break because I moved house. And because of that, you did the last podcast on your own, didn't you? Which we've had some amazing feedback from. But is it the fact that I wasn't on it that we've got good feedback?
Well, I did want to point it out because I was looking on the podcast stats. You can see the most popular podcast shows in sections. So if you go into iTunes, and that episode at one point was in the top 10 most popular money business podcasts because you can look by episode. So yeah, I don't think it was because you were here or not here, Andy. I don't know if that was any influence, but thank you for all your feedback on that episode. And if you're in the Money to the Masses Facebook group, which you should be, there's lots of good stuff going on in there. There was some good feedback we had via that group, but also via emails. And one of the most popular things I was asked or requested of me was to reveal the banks in question. Now, I've refrained from doing so far, and one of the reasons is also personal, because if I give out too much personal information, then that isn't a positive either, because fraudsters can work out where I bank and everything like that, because obviously, like anybody, there's information out there about me, so you don't necessarily want everybody to know where you bank, because people can then start to try and commit fraud in your name. So that's one of the reasons. So I'm still unlikely to reveal the bank unless I have a big change of heart on that. But thank you for your feedback and your suggestions and bits and pieces. I mean, there was one very good suggestion on that in the Facebook group, which was to not just check one credit agency, but to check every credit agency that's out there, because some of them may have slightly different notices on there. So somebody, I've forgotten his name, I wish I could give him the credit up, but if you go in the Facebook group, they mentioned of a good point that they had some fraud that occurred on their account where somebody had bought phones in their name, so credit was basically taken out, and it didn't show on every credit agency's report. So it is worthwhile, because don't forget, most of them you can obviously get free credit reports now, and so doesn't cost you any money to do that. So that's a very good point which I wanted to pass on. Now, as I say, to move on with the podcast, it is a new year. So lots of people, what they will do is go, right, it's the new year. I'm going to give you a list of things to do to try and improve your money. The good news is that I don't have to do that, because we spent a lot of time, effort and money building Damien's Money MOT last year. And originally it was supposed to launch in time for the new year of 2019. It was slightly delayed, like all good things. The technology took a little bit longer, and it launched, I think, in the February-March time. But it's been updated ever since. So if you are listening to this podcast, and no matter how good you think you are with money or how bad you think you are with money, go and do Damien's Money MOT. The easiest way to find it is if you just Google Damien's Money MOT, you will find the site, and it takes you just a few minutes. What happens, you go on there, it asks you broadly about 12 questions, multiple choice questions, which is why you can do it with one finger or thumb on your mobile phone. Flick through, it asks you some information. It's all anonymous. And once you've finished answering the questions, what it will do, it will give you a grade. So from A all the way down to E. And that will give you an assessment of how well you're doing with your finances. Now, those grades are bespoke to you as a person. They're specific. So it isn't that people who have more money or who are older will do better. It's how you work with the money that you've got. So therefore, somebody who is a student with not much of a footprint in the world can get an A grade, whereas a millionaire could feasibly get a D or an E. It's bespoke to you, which is why everybody's grade is different. So go and do an MOT. What it will do, it will show you the areas you need to work on, from budgeting to tax to pensions, you name it. It basically is a form of financial planning. It takes that logic, that theory, and applies it to your finances and shows you suggestions of where you need to improve or where you're doing well. And then you can sign up to a free email plan which will help you to improve your finances. So the reason I want you to do it is because it's the best way to try and make an improvement. We're not trying to get people to be absolute legends, the next Martin Lewis. It's about incremental improvement because it's addictive. So once you make an improvement, you'll want to do the next improvement. We've had some fantastic feedback, which you will see on our social media channels. And obviously, we've had 10,000 MOTs, more than that. It's more than 11,000 MOTs now that have been run since we launched it nearly a year ago. And what we know from that is there are a lot of people out there who obviously have improved their finances, but there are a lot of people that are making the same mistakes. And one of the big ones that we've seen is about 50% of parents do not have a will in place. And that is not surprising if from my side of the fence, because obviously I speak to lots of people and I know how people deal with their finances. But obviously, if you have children in particular, lots of reasons why you would want a will. But if you've got a child, then you want to make sure that your assets are passed on to the people you want them to. But more importantly, your will can stipulate who gets guardianship of your child if you and your partner, if you are married, die. And so if you die, and particularly if you're a single parent, you'd want to make sure who's the guardian, the legal guardian of your child or children. So if you're listening to this and you do nothing else for the rest of 2020, then go and make a will. And if you do the Money MOT, there is, what we do is we take you through to an article to explain how you can do it and how you can do it cheaply. And if you want to just find out that article anyway, you can go onto the website and search about how to make a will on moneytothemasses.com and we explain it. So it's all about action plan. It's to tell you what you need to do. It prioritizes what you need to do when you've taken the MOT and allows you to do it very quickly. So go do an MOT. Don't be one of the 50% who do not have a will who have children.
And just to further back up those stats of 50% of this podcast are parents who don't have a will. Yes, I said it right. I need to sort it out. So I will be logging on to Damien's Money MOT after this podcast and sorting it out. I promise.
You should do, Andy. My jaw just hit the floor. But that's fine. It doesn't matter that you don't. I think people just have to not bury their head in the sand. And that just shows you how common it is. But it's very simple to fix. And so make sure you do an MOT, make sure you do these things. There's lots of areas that people don't look at, some far more simple ones in terms of money saving, in terms of bills, but also retirement planning. So today is the best time to take action, and I will take you through the steps you need to do with that money plan once you've taken an MOT. And as I say, it's free.
We're going to be looking at investment insight. No, we're going to be looking.
No, we're going to look at. Right. The reason Andy and I are laughing, and we're going to carry on with the podcast. Listen to the end of the show because Andy has tried to introduce this section a number of times, and he's actually created a few outtakes without meaning to. But as it's the new year, I think it's still in a slightly jovial mood. We'll include them. What Andy was trying to say is that we want to still provide some investment insight. And as it's 2020, I thought it would be good to look at an outlook for 2020. Now, if you're an 80/20 investor member, I did a whole outlook piece on potential things that will be themes for the next year as we go through 2020. And I just want to give a brief summary of that for podcast listeners. And obviously we ended 2019 in a very, very bullish mood with stock markets. So we had the Santa rally. It did arrive. Depends which market you look at, actually. If you look at European markets, it didn't. UK, it did. It did arrive in America in a big way. And we ended up finishing 2019 with the S&P 500, for example, up at new all-time highs around 3,250 odd. And a lot of that was because of the bullish sentiment surrounding the trade truce, the phase 1 deal that's supposedly going to be signed in January. So there's still a lot of moving parts in markets. So where are we going to be this time next year? Now, I don't have a crystal ball, but interestingly, investment banks claim that they do. Well, what happens is they have clients, and clients want to know where a market's going to be. So what they do every year, the investment banks seem to line up and make their bold predictions of where the stock markets are going to close at the end of the following year. And so they did it in 2018 for 2019, and they've just done it for the 2020. So at the beginning of December 2019, they started to make bold predictions of where the US stock market, the S&P 500, would be at the end of 2020. Now, don't forget, where the US stock market goes, it tends to lead the rest of the world. So that's why this is of interest. So if we go back to the previous year, how good were they at predicting the stock market for 2019? Now, at the end of 2018, you will recall the stock market collapsed because the Fed was tightening. The US Federal Reserve was starting to withdraw QE, it was starting to tighten, it was raising interest rates, and the market reacted quite negatively. Then they did a big U-turn at the start of 2019 and they became very accommodative. But obviously investment banks didn't know that. So they made their bold predictions at the beginning of December 2018, before the market really crashed into Christmas Eve of 2018. And so they were quite bold with their predictions. And so generally speaking, they said the market would rise by 11% during 2019, and it would end up about 3,060. So bearing in mind when they made those predictions, it was roughly around 2,760. So they were being quite bullish. What happened, which is quite interesting, is when the market collapsed at the end of 2018, they all started to try and change their predictions to make them a little bit more bearish. But as it happened, 2019 was one of the best stock market years in a decade. And people focus on calendar years a lot, but what it does do, it kind of masks the full picture. Because if you look at 2018 across into 2019 and to the end of 2019, what you found was there was a bit of a V-shaped recovery. So we actually just recovered a lot of what we lost at the back end of 2018. But 2019 was very good. So in the end, investment banks, they underestimated what we actually achieved in 2019. They were very bullish, but they weren't quite bullish enough. But they did quite well. And I mean, that was probably just blind luck, really, or dumb luck. But what have they said this year, given that they were pretty accurate last year? So what they've said this year is that we're going to have another good year. And I'm not going to go through all of the individual banks of what they said, but they range from the S&P 500 being at 3,000 at the end of 2020 up to one investment bank says it's going to be nearer 3,450. So that's quite a range. On average, they think we're going to be around 3,300, which at the time they made these predictions, you have to remember it was at the beginning of December 2019, that would have been a 6% rally from that point. Well, as I make this podcast, we are around 3,250. So that's not much wiggle room for a lot of the predictions. But what they are still fairly bullish for the next year, but they are a little bit more measured because after such a stellar year, then they're thinking that there aren't as many gains because the market is looking quite stretched. But we have to take these things with a pinch of salt because if you'd gone to the beginning of last year, no one would have expected quite the year that we had. But I know people are intrigued where the smart money is placing their bets or their thinking of where markets are going to be at the end of next year. Interestingly, on the opposite to what we had at the end of 2019, where people started to become suddenly more bearish because what the market was doing at that point, we had the opposite. this time around, where the market rallied really strongly into the end of 2019, a lot of investment banks were starting to scramble to try and raise their predictions for the end of next year. So it just shows you they don't really have a lot of clue. They're really basing it on what's happening right now. And as we're making this podcast, there is obviously news that's broken about what's going on in the Middle East and what Donald Trump has done in the Middle East. And that is going to have obviously an impact on markets. Probably temporarily, because if history's any guide, what happens, unless this escalates very quickly, then geopolitical issues such as these are normally quite transient in markets, and the buy the dip mentality is still prevalent in investment markets. But before I finish up on this investment theme, I want to throw out some themes to ponder. So in 2020, I still think, despite the fact that the market has completely dismissed the idea of a recession, we are still going to be talking about that at some point, probably in a not too distant future. Everybody thinks the economic cycle has turned, things are going to only be positive. Then that is almost a sign that probably we're being a little bit complacent. If you look at the Fear and Greed Index, which is done by CNN, it's like a measure. It takes about 7 factors into account. And it's a measure that goes from 0 to 100, where 0 is extremely fearful and 100 is extreme greed as the emotions that are driving markets. At the moment, it's hitting 97. I don't think it's ever been higher. And so normally, it's not necessarily a reliable indicator that the market's about to collapse. But if you take what Warren Buffett always says about fear and greed and what's driving markets, you should be greedy when people are fearful and fearful when people are greedy, then markets are being quite enthusiastic at the moment. And that's because they're dismissing a trade war escalation, they're dismissing a recession as two of the big key factors, but I think they are still lurking in the background. So that is something I think that if you watch the Midweek Market Show, we're going to come back to probably within the first quarter of 2020. Now, if you want to know more about these themes, then I did a whole piece for 80/20 investor members. You can take out a free trial and have a read of it yourself. As I mentioned, the trade war is still a narrative that is or still an issue that's out there, but it's been again dismissed. There's a cycle we seem to go through where things seem to improve. They promise that we've got a deal, then it seems to slightly unravel, the markets sell off, when we've got another deal and the market rallies again and we get tariffs and it falls. We seem to be in that cycle, and we're on a positive part of that cycle. 2020 is likely to be no different unless we get some surefire deal. And this might have some relation to the US election as well, because don't forget, at the end of the year, in November, we got a US election, and Donald Trump is going to be very conscious of that. And as we go through the year, people will start focusing more and more on the US election and its impact potentially on stock markets. And as an aside, years where you have a sitting president who basically becomes re-elected, they tend to be very positive for stock markets. If you have a very open field, then it tends to be very like a muted year. You tend to only get about a 1% gain, whereas if you have somebody who gets re-elected, you tend to have a gain of about 10%. That's if they ran for re-election. So that tends to be positive throughout that year, that people are thinking that the current president will be re-elected. The other thing was
that to do with continuity and everything else,
exactly that. Yeah. So continuity is something that markets like. Markets don't like uncertainty, but then they like some form of certainty, even if that isn't necessarily a positive type of certainty. Yeah. They like to know what's going on, try and predict the future. Monetary policy is going to be a big thing. So we're talking about what central banks do, if they do more easing. At the moment, they're on easing mode, and actually, well, I probably should say they're not tightening. They're sort of sitting still, watching briefs at the moment. But there's a potential for them to start easing again, especially if the global economy starts to slow. But there is a thing that hasn't really been picked up a lot, and I wrote about it for 80/20 investor members back in December. I think it was in December, it could have been November actually, was about the potential for the US dollar to tumble in value because it had been strengthening for a period of time. And that has started to happen actually. And that has huge implications on asset prices around the world, which assets are going to do well. In a nutshell, a weak dollar is normally very good for emerging market assets. It will start to have an impact on commodity prices. So you'll start seeing things like gold and potentially oil do well. So have a look out there in the coming months to see that if commodities, which have largely been unloved over a large period of time, start doing well. And also inflation could start picking up, particularly in America, but also globally. And there are signs of it, even though no one's talking about it yet. I think this is something that could be a theme, that we suddenly see inflation start to pick up, which could cause a problem. And assets that do well under inflation, which are actually things like commodities, will start being things that people will want to try and buy, and they will try and not hold things that don't do so well under inflationary environments, which is typically things like bonds. So if you want to know more about those types of assets that do well in those environments, like I say, I've done more on 80/20 Investor. Of course, Brexit is always going to be a big issue throughout this year, and therefore currency rates. So the pound, what's it going to do? There are a lot of people that are betting that it's going to be a very bullish year for the pound. It's going to rally against the dollar and every other currency as we seemingly solve the Brexit crisis. But we have been here before, so we have to take that with a pinch of salt. All predictions tend to be finger in the air jobbies. So that will be interesting to see what happens, because obviously don't forget the pound has the biggest impact on our portfolios as investors in the UK, because it impacts the FTSE 100, it impacts our overseas holdings. But generally speaking, people are very bullish on the pound and think it's going to rally up to easily $1.35. It's down around about $1.30 at the moment. It's pulled back recently, so they're thinking it's going to rally to at least that. I've seen even more crazy upward predictions, but we'll have to wait and see. And I just want to throw out some other sort of food for thought. Company earnings is one. I think we're going to probably see some stories about company earnings and how their growth of them. So while stock markets have been soaring, the earnings for those companies haven't, and in fact they've been largely contracting. And so there's this dichotomy, this divergence between what the companies are actually doing and what the valuations are suggesting they're worth. And that could be potentially a problem going forward. And obviously, the other thing I would look at is the US stock market versus the rest of the world. The stock market in America has largely diverged away from everybody else. And so we're seeing European markets, we're seeing Asian markets not enjoy the same rallies that the US stock market have enjoyed. It's particularly over the last 3 months. So is there going to be a catch up from the rest of the world or a catch down? So I'm thinking that could be something that we come back to. And of course, another thing is style shifts in investing. So we saw some of that at the back end of last year. We saw value stocks outperform growth stocks. We saw some domestic focused stocks, so say smaller companies, start to outperform large caps. And that was partly because the prospects for the domestic economies was improving. Will we see more of that continue, or will we revert back to the point where we've been for a number of years where growth stocks have outperformed value stuff? So when we talk about growth, it's particularly things like the tech stocks, the Apple of this world, and all those types of very growth orientated companies, rather than the unloved things like financials and stuff like that. So I think there's a lot to look out for in 2020. That was just a bit of a whistle stop. Themes to look out for, things to read about if you see them in the press. Try and look for both sides of every story. Don't fall foul of confirmation bias. We only read the stuff that is going to reaffirm your own view. So there are a lot of people out there saying the market's only going to go higher. There are people out there who are saying the market's going to collapse, but they only ever push out the same old stuff which confirms their own biases. Look for the other side of the coin, because there's lots of reasons to think that the market could collapse from here, but there are plenty to suggest reasons why it could keep going higher. And one of those is quite simply because the Fed and global central banks, but particularly the Fed, is just pumping money into the global financial system. And if the last decade is anything to go by, then don't fight the Fed is probably the most successful investment strategy that there has been in the last 10 years.
So that's it. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. On Twitter, it's at moneytothemasses with the number 2. We're on Instagram, YouTube. And don't forget, if you're not already a member, head over to Facebook and become a part of our Money to the Masses community on Facebook. You just need to search for Money to the Masses community and you'll find us there, and you can chat to us and talk to us about anything that you've listened to in the show, or post questions and speak to other like-minded people in the group.
Yeah, and it's a great group because people go in there and they answer questions and help people with their problems. And at this time of year when everyone's just trying to sort their finances, it's a very supportive place where people actually are being genuinely helpful. So that is it. We are done, Andy.
That's it. We're done. Until next time. So we mentioned at the start of this podcast it was going to be a slightly...
It's going to be just completely shite. There goes our explicit rating.